Welcome to another episode of the Capital Employed podcast. For this episode, we had the pleasure of being joined by Tim Delaney, co-founder of Immersion Investments. Tim founded Immersion Investments last year with David Polansky. They manage a concentrated portfolio of small and micro-cap equities. In this episode, Tim talks about what type of companies and situations they like to invest in, their research process, and then discuss two companies he's bullish on for the long term. Please enjoy my conversation with Tim. Hi Tim, thanks for coming on to the podcast.
Oh, Jon, thank you for having me.
Could you give a brief introduction to yourself and Immersion Investments and what is the objective of your fund?
Yeah, sure. So Tim Delaney, I've been in finance for 25 years and in the equity markets for about 20 of those, mostly on the buy side. In June of 2021, my partner, David Polansky, and I launched Immersion. And it's an investment partnership that we're trying to focus on sub 5 billion market cap companies. We're highly concentrated. We can own up to 20 names, but currently we only own 12, with the top 4 making up about 70% of our AUM. Our anchor investor is a family office that's taxable, so we're long-term. We're also long only, so we try to be tax efficient. And generally speaking, our mandate is to find companies that can compound annually at 20% net of fees over a 3-year rolling basis.
And what type of companies do you like to invest in? What's sort of the ideal immersion setup?
You know, it's funny because we really are company specific. It's an interesting question. We had an institutional allocator ask us, what's your style? Are you growth or value? And I think my quip might have been a little off-putting to him because I basically said we're in the money-making style. So we're agnostic, right, to growth or value, or domestic or international. We focus on the company itself, and so we really are bottom up, and we kind of see where the company takes us. But if you look at our portfolio, you'll find basically 5 types of investments, right? And these are sort of outputs, not inputs. So you can't really search for these companies, but when you find them, the ones that are in our portfolio tend to fall into 5 distinct categories, right? So the first one is the underdog. It's really overlooked. People don't like it. Investors don't like it. There are a lot of surface level issues with it. You know, oftentimes it's too small. It doesn't have a great float. It's not in an index. Almost always there's no analyst coverage. So, for us, when we're looking at an underdog, we get excited about it because the economics are there, the management team's there, the product's there. What it really needs is to learn some IR, right? Some investment relations, or to tell their story a little bit better, or to try and improve their liquidity and get some other analysts involved. The next type is the babushka doll. When we came out with the babushka doll, people came back at us and said, oh no, it's the Russian nesting doll. So whatever you want to call it. Basically, you have a large legacy company, but within it, there is something growing. There's an asset that is being, again, overlooked by the market, and it's growing fast. It's very profitable. Management also has to be able to recognize this and put the resources to it. So, oftentimes you'll find management that'll have a jewel within it, but they kind of ignore it because it's not part of the core business that they've done. So that's another piece that we've looked at. The social pariah, that's pretty easy. They're hated. Generally, they've burned investors in the past. They've done something really unsavory, or they had a failed IPO. Basically, some other catalyst has come in to change it. And usually that's a management change, a brand new direction, or, you've really gotten rid of the bad actors, or a new product line that isn't as distasteful. And then we have the ugly duckling. It's exactly as the name says. It's a subscale business. It's growing rapidly. It doesn't look pretty right now because it's investing all of its free cash flow and cash flow into the product itself, and so it doesn't look good. But as you sort of spring the ugly duckling along, it turns into the swan. And then the doubted champion is our final one, which basically is a company that keeps on performing well and keeps on growing at very accelerated rates. And the rest of the market looks at it and says, geez, they can't keep doing that. But they do, and they continue to do it. So, oftentimes, again, if you break these down, the doubted champion is going to be in the traditional quote unquote growth bucket, where a lot of the others are in the traditional value bucket. So again, we don't care about growth or value. And we're agnostic, again, to whether it's in the US or international. We tend to shy away from speculative companies, very binary companies, and mining companies, things of that nature. Historically, we have stayed away from the financial sector, banking in particular, just because to look into see the quality of the loans. However, we've continued to do due diligence. There are some really high quality banks that we may invest in at some point or something like that. But currently they are not in the portfolio.
Yeah, I love the 5 names that you've given to each there. Which one do you think will bring you the best returns?
Well, hopefully all of them, right? But our biggest positions tend to have a social pariah and a babushka doll component to them, or more than one of these components involved, right? Oftentimes, you can have the babushka doll and the ugly duckling combined into one. It's very easy to have the social pariah and the underdog sort of put into one. For us, we really believe that any one of those scenarios is going to bring you the 20% IRR that we need as part of our mandate.
Okay, and you say you invest internationally. What is your discovery strategy? How do you find these companies?
Yeah, so you mentioned Twitter, and Twitter's great. Everybody with an idea likes to throw up a piece of Twitter. So we do have some trusted folks that if they say something, we take a look at it and kick the tires and things of that nature. But the discovery on international isn't that different from the discovery in the US, right? You sort of read about a company that is doing something interesting or something different. And you go through the same processes. You just gather as much data as you possibly can. You synthesize it, and then you start to sort of see what they're trying to achieve. And then from there, you start to go into the management team and seeing, are these people able to execute? And Europe's a little funny, a little interesting in the sense that, historically, companies. It's hard to be a social pariah in Europe. Although we do have one of those in the investments over there, because once you're branded over there, you are shunned. The amount of international or domestic European funds versus in the U.S. the international investment funds, there aren't as many, and they're not as forgiving. And then talking to some portfolio managers over there, the path from being an analyst to a PM seems to be a little bit more difficult. And so in that sense, and again, I'm not trying to bash my brethren in investments on the international side of the pond here, but they tend to be a little bit more conservative. So for us, when we're looking at that, we fly over there, right? So my partner David was in the Netherlands at the beginning of November. I was in Spain at the end of November, meeting with management teams and kicking the tires and talking to competitors and talking to suppliers. Really, doing our nitty-gritty due diligence. When we look at it, the fair value of what that company can be, we may discount it slightly just because it is a European company, unless that investor base is more from the U.S., because the U.S. it tends to be able to stomach some PE expansion, and that's not to say that the U.K. can definitely they have their share of hyper growth names over there, but I think for the rest of Europe, you have to really take a look and sort of adjust your fair value slightly. And I'm not talking drastically, but 10% or something like that is not out of the question.
I think it's a good observation. Out of the 12 stocks you say you have in your fund, can we talk about two of the stocks you're most bullish on for the long term? And what was your thesis for investing?
A very interesting one that sort of falls under the social pariah and, ugly duckling, I guess, too, is a domestic stock here, right? It's Legacy Housing. So they are the fourth ranked player in manufactured homes. They have two lines of business. They have the manufactured housing line, which is the traditional line, and then they have the lending piece. Essentially, when you have the manufactured housing, they will sell to independent retailers, and then they will sell to their own stores, and they will sell to mobile parks. And within those, they have a financing component that they can use when they are taking their cash flow from the manufactured housing and putting it into their lending book. So when we first heard about them, they're the fourth ranked player. We were thinking about, okay, what is going on in the world? And obviously COVID was and still to a lesser extent raging, and the housing market was unaffected and continued to do well. And we said, okay, well, low cost housing seems to be a pretty interesting place to be. And frankly, my partner was looking at housing at the time. Not that he was looking at manufactured housing, but it sort of spun out of that conversation. And so we started to kick the tires on the publicly traded manufactured housing companies. An interesting thing about Legacy, they take the cash flow from their manufactured piece and run it through operating activities to hit it over to the loan book instead of putting it through investing activities. When an analyst would screen for this, it would show up as if they don't have any cash flow. And so that intrigued us right away because we were like, oh, well, here's something that is probably being missed by everyone who uses a screen instead of, the old school sort of analyst way of actually pulling up documents and reading them. That got us intrigued. As we started to go through it, we realized that this is a company that is growing and doing very well. However, their communications with the investing world is atrocious. It was horrible. I think their second quarter release basically said, "Hey, everything's fine, and here are the numbers." And I'm not exaggerating. I mean, we can go pull it up and take a look. I think it was 2 or 3 sentences. That's going to scare off. That's going to scare off the investment community. Coupled with, they've been in business since I believe 1982 or 1983, but had only gone public in the last 3 years. When they first went public, within 6 months, they had fired their auditor and turned over their entire C-suite, except for the 2 founders, Ken and Kurt. These are pain points that we're drawn to. We don't run away from these things. We're like, oh, well, this could be really interesting. So frankly, trying to get in touch with them was difficult. We had to go through some back channels, and finally, the CFO reached out to us and said, basically, "Hey, we heard you're trying to get a hold of us." We're like, "Yes, we want to talk about the company." So we had a good conversation, and then they were having their annual meeting, and it was going to be closed, so they weren't going to broadcast it or talk about it. So we flew down there, and by down there, it's Fort Worth, Dallas, Fort Worth, but they're located in Fort Worth, or just outside of Fort Worth. We were the only 2 investors there. We were the only 2 outsiders there, frankly. We had met one of the founders, Kurt, for lunch, Kurt Hodgins, and we had a pleasant conversation, but we had not yet met Ken Shipley. And Ken is the chairman. So we go into the meeting, and legitimate, cowboy hats and things of that nature. And Ken is giving us sort of this skeptical look as we're going through and approving, the the various motions being brought forth. Now, it should be mentioned that Kurt and Kenny own 70% of the equity. So regardless of our percentage, we're not going to be able to outvote them. So I don't know if he was worried that we were going to object or something to some of the directors. But at the end of the day, after the meeting, everybody warmed up and they realized that we were there to talk to them. And we talked to them about, listen, you should really think about breaking out the manufactured piece and breaking out the lending piece into two separate reports. And, they haven't done that yet. Maybe they will, maybe they won't. It's a little unclear. But when they realized we weren't trying to go in and tell them how to run their operations that have been run for 40 years here, they really started to be receptive to us. That day, we went on a tour of their facilities and had great conversations with a little bit more of the rank and file employees. We met with one of the general managers, and we talked about supply chain issues, if they were real or not. We talked about labor issues, which are very real. Particularly in that area, there's an Amazon warehouse that is, warehouse does not do it justice. It's a skyscraper on its side, basically. And so, they're competing with a bunch of other people for labor. And that's one of their pain points and has been for years, but in particular, the last couple of years with COVID, it's been difficult. However, they've been able to push all their costs through because of the demand that they're seeing. We had great conversations with them. And then that evening, after their director's dinner, they invited David and I out for a couple of drinks, and we met with them and we started talking about IR and how abysmal, their communication has been. And if you're trying to really reach the investment community, you have to sharpen it up a little bit. So they were coming at it from the point of view of, we've run this company for 40 years and we're really good at what we do. And if you want to hop on, then hop on. And if you don't, then don't. And I understand that attitude, except they trade at half of the multiples of their peers. And they were each selling about $2 million of stock a month. Ish. It should be mentioned that they at the time they each took about $50,000 a year in salary, and so they were in their minds they were trying to create liquidity by selling, and also by some diversification for their own personal estate planning. Which they're both in their 70s, and so that makes Kurt is 67 and Kenny's I guess 72. From that standpoint, we said, well, you're not really creating liquidity, and you're kind of confusing the market because you're selling. And you're selling at a valuation from our model that is about 50% of where you should be. If you communicated a little bit better, your stock might go up and you would be making more money. And so they took that to the heart. And in fact, the directors did as well. So this just happened at the end of November. We've had great conversations with them through December. Kurt just put out a new compensation plan where he had stopped selling 3 months ago, his shares. They've locked him up for another 4 years, and he has some stock incentives that only trigger if essentially the stock goes up by 50% and then 100%, more or less. We like that. It has key man risk, right? Kurt and Kenny are it. So we told them too, the investment world wants to know what happens if Kurt or Kenny disappear. And so by having Kurt come out and say, well, I'm definitely going to be here for another 4 years, you don't have to worry about me. That was well received, but he also knows that he has to start bringing some other people into the fold, into the C-suite fold. So, that was one of the more nitty-gritty sort of meetings that we've had, where you're going through, and it's a great operation. I mean, they do a fantastic job. They have the macro behind them. And we're not trying to tell them what to do, right? I mean, an easy piece would be, hey, go to a bank and borrow more money for your loans. And, why are you taking it out of the manufacturing side and then buy back your shares, right? Or something like that. But they won't do that, or they'll consider it, but they're conservative because they've been through, the late 80s when there was massive consolidation of smaller homes, and they've survived and been profitable, according to them, every year except for 1 year out of the 40. From that standpoint, it's hard to argue. And frankly, the things that they need to do are sort of just telling their story better. I mean, really, that's what it comes down to. So we're not getting into their operations. We're not telling them to hire people or change things. These are people who've been doing this in their specialty for much longer than we've looked at the stock. So we're going to default to them, and we're going to continue to monitor and see how they do. Frankly, it's something that we see 100% upside in. If the market can realize some multiple expansion, but even if they don't, they're going to continue to just pump out these houses. If they can do something about their labor and labor costs, which they may or may not be able to do, depending on their appetite again for risk. If they opened up something in Mexico, or even just trying to create another manufacturing plant, which again, they're very conservative. I don't know if they would do that. It's expensive to do those sorts of things. And then you still have to fill it with labor. But they also have another little, I don't want to give too much emphasis on it, because people get really excited. And that's, the value guys, the pure value guys really like it because they own a bunch of land, raw land. They own it. The areas that people care about are right outside of Dallas, right outside of San Antonio, and right outside of Austin. And they are developing them slowly, very slowly, into their own manufactured housing parks. And by slowly, I mean they're getting 10 permits at a time here for a lot of acreage. But at the end of the day, you could, in theory, either have something that could be spun off as a REIT, or have something that's beholden to you as a demand entity within your own company. But that's years off. And frankly, in our model and our thinking, we add about $2 a share to that. When if you were talking to the pure value guys, they might add $9 to $10 on it. But we just think it's too far off. But it's another little asset that's hidden within there. I wouldn't necessarily put that in the babushka doll piece because it's not growing. It's just kind of a slow positive, if you will.
I looked on their website, and I have to say the houses they built, they're very attractive.
That's Kurt. So Kenny's from Texas, and Kurt, I believe, is from Michigan. He went to the School of Engineering in Michigan, and then went to University of Austin Law School in Texas. And he designs the houses himself. And we were able to see the 10 various SKUs that they had available, and they really are. I mean, you wouldn't know you're in a manufactured home when you go inside. They're beautifully done. The level of detail that they put in and the thinking around the end customer really is, I sound like I'm selling for them. I'm not, but it really was impressive. So for instance, they made sure that a certain room would have 6 inches more, so that when you open the closet door, you wouldn't hit your vanity or your nightstand next to your bed, and that you would have room for a nightstand in the bedroom. And talking to the general manager and Kurt, he said, oftentimes you go in and it's 3 or 4 inches, but you're able to actually have a vanity in the bathroom where you can store things underneath, whereas in other manufactured houses you can't. So they are very thoughtful. And they're designed for warm weather. That's the other thing. So they're selling in Texas, they're selling in Florida, they're selling in Georgia, they're selling in Louisiana. I mean, technically you can get them anywhere, but that's really where the states that they're really selling into. And those are the states that are attracting a lot of new people. Again, we're not macro, but we look at sort of the tailwinds pushing this trend, and, lower costs, coupled with a demographic shift into one level living and into warmer climates, all these things add up to be pretty positive. I wouldn't put this in a category. There's been talk like, oh, maybe they'll sell and someone will buy them. Maybe. I don't see that at this point, particularly with a new contract. So if people are holding this in anticipation of an M&A deal, I would not get that excited, but never say never. If the price is right, anybody will sell. This is their baby, and they grew it, and they're very proud of it. It really is neat. Now, if they can just give a little more detail and be a little more willing to talk to investors, I think that the stock will continue to do well. It's done well in the last 6 months, and honestly, it has another 100% to go.
Yeah, it's a fascinating company. Yeah, thanks, Tim, for sharing that one. And what's the other company you'd like to talk about?
There's a company called eDreams, right? And it's based in Spain. It's a twofer. It's a social pariah and it's an ugly duckling. It's an online travel agency, a European online travel agency. And if people know anything about online travel agencies, they've kind of become a commodity, right? You're really now your biggest competition might be Google, and yet that's your number one ad provider, right? Because the first thing people do is they go to Google, they type in where they want to be and where they want to go, and Google will spit out either sometimes another OTA, but oftentimes its own little travel itinerary for you that it's put together. So it's a symbiotic relationship. It's not very good. And so 5 years ago or so, eDreams came up with the idea to create Prime, which is a loyalty app, basically, or membership app. They have right now, they're the number one OTA for flights in Europe. They're twice as big as the largest player there, and they're the second largest globally, but they still only account for 3.5% of European traffic and 30% of the OTA market in Europe. Aside from being big enough and starting out with this Prime subscription service, COVID hits. Not a great time to be in the travel business for the last 2 years. And that's actually what drove David and I to check them out, because we launched June 1st, 2021. At that point, the COVID recovery plays had already started. You had Live Nation and a few of the other venue places already trading above 2019 levels. But at that point, Europe was about 2 months behind the US in reopening and in stock appreciation, frankly. And so we started to really be drawn to things that were happening over there that we could take advantage of to sort of replicate what had already happened. That led us to eDreams. We read a research report from Grizzly Rock, which is someone who's online, and we're very intrigued. We started to kick the tires. We started to talk to as many people as possible. And we were both like, oh man, are we really going to buy a European OTA? And that's probably a good sign, right? When you're like, eesh, we're looking at this thing and I really don't want to own this. Oftentimes it's best to keep going, but in this case, we were kind of like, well, there might be something here. Let's dig into it. And we found that the Prime is the whole key to this. Prime, their loyalty membership program, it's their massive differentiator. Basically, so it's €55 a year, and you get discounts on your travel. You get a special customer service line, and you get access to special deals here and there. And it's not just, if Jon and Tim are flying together, if you book the trip, I would get the discount as well. Currently, there are 2 million Prime members, right? And so that goal 2 years ago was their 2023 goal. And they added about 500,000 subscribers in Q2 of their 2022, because their fiscal year June 1st. So it's through September 2021, they basically added 500,000. And if you go back during that time, that was still pretty much in the meat of a lot of lockdowns in Europe. People were getting antsy as different countries opened up under different requirements. People started to book trips. To be able to do that really speaks volumes in our mind, because they don't advertise. There's de minimis advertising. They're not out there pushing Facebook ads, right? What they're trying to do is actually get away from the Googles of having to pay for that high cost of acquisition of these customers. So for 2025, and again, they're ending June, they're looking for a target of 7.25 million subscribers. That's massive growth. 3x, over 3x for now. Why does that matter? Why do we care? 55 euro, 7 million. Yeah, that's great. But what it really is, it's the cost of customer acquisition. According to them, you have a 30% lower cost. Prime members also book 2.7 times the amount in year one versus non-prime. When you're thinking about it, you're having the same customer book 2.7 times without having to pay for them through Google to be acquired, whereas a non-prime person, you do. And then in the second year, you get another subscription fee. And if that person has rejoined, they go 2.9 times more. It's a huge cost savings for them. According to them, again, it's for a repeat customer. It ends up being 75% less. You have a stickier customer. You have more loyalty, a repeat customer coming in. Again, this is according to their metrics and their numbers. Value to them is 2.5 times that over a non-prime member over a 2-year period. When you're looking at that and thinking about it vis-a-vis other OTAs, it resonates really well. eDreams, stepping back for a second, its old iteration was not nice. It was not good. It had a failed IPO. It had a failed takeover bid. It had a CEO that, I would put it not necessarily, I guess under sort of unethical moves where, if you were trying to fly British Airways and you typed in British Airways, eDreams may have a clone of British Airways website. You might accidentally book eDreams instead of British Airways, and obviously at a premium. Those people were thrown out, and the new CEO came in and said, look, we're going to be a tech company. We're not going to be an OTA company because OTAs are commodities and our commodity is eroding. Google is taking our bigger and bigger share of our customer. We need to do something. And he came up with the Prime membership. They beat 95% of the time on flights versus the top 10 airlines and the other 3 OTAs. That's the reason why people tend to join. Then when you go and you look at why they stay, it's because of the ease of booking in tech and the customer service that they get. And this is all, if you go to their website, you can download their investor day, and it's all certified by KPMG and other people. So this isn't just them saying, yeah, this is, people love us. It really is what is happening out there. We flew over there. We met management. We hung out during their investor day. We saw their tech. We saw their passion. We saw their algorithms in motion, and it really is something to behold. So they have a 5-year head start on their competitors. So if someone else wanted to come in and say, okay, well, I'm going to start a loyalty app, right? Because that's generally what the pushback is. It's not something you can just turn around and do. It's much more complicated than people believe, because if you are trying to use an app to book, over 662 airlines and 2.1 million hotel rooms, which is what they have in their universe, you just can't do it day one and try to beat them. This is a company that is a social pariah, but is also an ugly duckling, because the reinvestment, and frankly, to be fair, they did not disclose the economics of their Prime membership up until November. They would say basically, look, it's profitable, trust us. But you and I both know that if we give someone $100 and they only need to spend 80, then that's not a good business model, right? So, but it turns out that was not the case, and what they said was true. They went through their model and basically explained the cost of acquisition being put down and the value, the long-term value of these subscribers. Their goal of having 7.25 million subscribers at their fiscal year end of 2025, that's another 100% upside. from where they're being valued right now. We do think that they deserve to be traded at a premium from other online travel agencies. Some people would say, they should have a valuation of like a Netflix or an Amazon, and I'm not there with that. I'm not too far away from it, thinking that that 100% upside from here is definitely something that seems achievable, particularly since in the last 5 years, the C-suite has done everything that they said they were going to do. Every single metric that they hit, every single goal that they put out for themselves, they have hit in both in the financial realm and in the subscriber base realm. So we're pretty excited about them. And we think that as COVID and Omicron either dissipate or we come to some sort of new normal, that again, this is a company that has great tailwinds behind it.
Yeah, I can't help but agree, especially as you say, when COVID starts to fade away and these lockdowns. Thanks, Tim, for sharing those two companies. I think they're both fascinating. It's amazing where you find these little companies, well, these not so small, but these companies tucked away. But
well, it's fun too, right? Because I mean, the juxtaposition between legacy and eDreams is massive. It really is. The difference between how investors are treated and are thought about. And again, not to beat up on poor legacy. I think they get it, and they're starting to really turn around and do a fantastic job. But eDreams had it down, right? They were welcoming. They showed you. They opened the kimono, right, and invited you in. They didn't make things difficult, and they're sending you information. So it's just this interesting, lovely world that we get to invest in, and just to have different business models, but the different people behind the business models that are really, it makes the job fun.
So where can people go to find out more about you and Immersion Investments?
So they can find me on Twitter at Boring PM Guy. And they can find my partner, David Polansky, at David H. Polansky on Twitter. Or you can go to the immersioninvest.com and send us a contact or go into our contact page and just send us a note, and that'll be directed towards us.
Tim, thanks so much for coming onto the show. It's been a pleasure to listen to you.
Yeah, Jon, this was a lot of fun. Thank you so much for inviting me. I really appreciate it.